So I'm here with Eddie Mohammed. Eddie, what do you do?
So I'm the president and CEO of Alliance Business Solution. It's a company that I created during the pandemic with the core focus of helping businesses secure capital, essentially when the bank says no. So how we're able to accomplish this, we built a nice network of funding sources nationwide that is comprised of SBA lenders, bank lenders, specialty lenders, non-institutional lenders, all in hopes to create options for the different needs that we see and the companies have. And we're able to be that conduit of delivering urgently needed capital to companies who have basically been underserved by their local banking.
And how did you get into that business?
Well, I'm a former banker of 20 years myself. I excelled in commercial credit, commercial lending, and the part of the business I enjoyed the most was the commercial credit piece, where helping businesses secure that capital to grow and thrive in any economy. And obviously, in my roots, my parents and grandparents were small business owners, so I just have a natural affinity of wanting to help
I was going to
business.
ask you because I understand that your focus is on small and medium-sized businesses.
Yeah, my focus starts from the small business sector all the way to the mid market space. Case in point, I'm there face to face and interacting with the business owners, being part of their journey and being part in the different parts of their journey. And I find it very fulfilling when I meet a client at this stage, and later on, because of the work we did together, they're able to achieve a certain level of success and so on and so forth, and know that I was a part of that. I find that to be very fruitful.
In what defines a small business? What makes it a small business that is to a size enough for it to be able to get a loan?
So the banking world has a gauge and parameters of what they define small business. I believe some banks define anything under 1 million all the way to 3 million as small business, or anything from 500,000 to, let's say, 5 million, and then above that it's mid market. So financial institutions have had guidelines. The Small Business Administration, the SBA, has their guidelines. But in essence, anything from basically zero revenue to about 2-3 million, you're still in that small business space. Once you exceed 5 million and trending upwards, you're entering what's called the mid market space.
Fantastic. So we're going to have a little bit of a conversation with Eddie where we're going to ask him some of the questions that we all have about lending, and especially how to get the right funding for your size company. Eddie, thank you.
Absolutely, pleasure. So capital readiness is, if you, how do I put this? It's almost creating a state of mind or a situation, right? Companies that I usually come into are in a situation where they're very stagnant. They have very poor cash flow or very challenged cash flow. They're not able to make any kind of decisions and execute those decisions because of their cash flow situation. So by putting them in a better situation of capital readiness, meaning they have ample working capital, ample reserves, so when this financial decisions come about, they're able to take action. So I'm really it's a process of empowering them to take action by making them capital ready and making sure they have an ample amount of capital to execute whatever their growth agenda is designed to do. So preparation is key. I would say it's a big part of what I do is helping clients get a better view of their mission statement, but also understand that their objectives has a lot of hurdles along the way. And my job is to identify these hurdles and help them prepare for them and mitigate some of these hurdles. So preparation is key. You always have to prepare for whatever agenda you have up against, and obviously prepare your clients and set right expectations along the way. Yeah, so by having access to both, it gives me access to two sets of guidelines. There's no one size fits all in my world. There's no cookie cutter. So at least my approach is one where I take a very consultative approach to each client that's in front of me. Not every solution is going to fit. And not every client, even if I have two clients of a similar nature of business, their needs might be different. So I have to be able to always to be able to formulate and craft up a solution that makes sense for that client situation. Sometimes that solution can come from an institutional lender, or sometimes it has to come from a non-institutional lender, more of a custom piece. But it all depends on who's in front of me, their needs and their challenges, and what works best. Yeah, so being a former banker of 20 years, I could tell you there's three key reasons a banking institution will turn down a credit request. Either they don't like the industry that client is in, they're not just very fond of it and they don't cater to it. The company's credit profile may not be up to par with the standards of that institution, or they may have shown a loss, say a year ago, 2 years ago, even as far back as three to 5 years ago, and the bank that doesn't sit well with them. Anytime there's a loss in any of the history of the company, it always just raises a red flag for the bank that what's going on there. But the reality is, every business throughout its life cycle and through its journey is going to face a rough year, a rough season. I think it just speaks to their character when they're able to come back from that and jump strong and get strong again. I think that to me shows more resilience than worrying about a loss they had 5 years ago. I'm more interested in how they bounce back from that loss and momentum forward. Yeah, so I operate a boutique operation. I do not cold call. I do not buy leads. I don't solicit. So I would say 100% of my business is referral basis, and referral based business relies heavily on relationship building. So I'm building the relationship. I'm building my brand, my reputation, and these relationships, as we cultivate them over time, wind up yielding a multitude of transactions from the same party sometimes. So it's key. It's essential for the survival of my business model. So in the business world in general, debt is leverage. So if you're a smart business owner, you're using somebody else's money, in essence, to make money for the company and make the company more profitable. It's very tough for a company to use their own funds, aka bootstrapping, they call it. You eventually have a need that your own funds cannot accommodate. So what you do is you find out ways to leverage capital from banks and other institutions and price it in a way, or hopefully achieve pricing in a way where it doesn't eat too much away from your profit margin. But case in point, the good old saying, it takes money to make money. You just have to be smart enough to figure, by borrowing X amount of dollars, how does that translate to your bottom line at the end of the day? What does that infusion of capital into your company translate to your bottom line? And that's a reflection of your resilience as a business owner. So when companies have been around, let's say 3 to 5 years, when the higher their revenue size is, the higher their lending capacity is, right? So if a company is seeking, you know, $20 million or $2 million, it's going to fall back down on their capacity to pay that debt. So obviously, companies with stronger revenues have the capacity to back larger credit facilities. So, case in point, once a company to me hits 1 million or 2 million annual sales, they're at that point where they're ready for some major growth, and they're one transaction away, or one season away, or one injection away from really springboarding into the next level. Springboarding potentially from the small business sector to the mid-market sector in some cases. So yeah, it does their ability, and they know it. They know the larger their capacity to secure larger credit facilities, to leverage them to fulfill their growth agenda. Yeah, so there's a lot of different types of funding sources, and the repayment schedule are different. There's a lot of programs out there that companies kind of shall we say, pull a fast trigger on and take it because of time crunch, and they wind up being totally a detriment to their growth instead of helping their growth. Case in point, super high interest loans, loans that to be repaid back in a quicker fashion, like let's say weekly, bi-weekly instead of monthly. They miscalculate the profit margins, they miscalculate the cost of capital and how that translates to their net profit. So as a result, they take on debt thinking it's good debt with the intention of that debt increasing their bottom line, and it winds up that that debt eats away from their bottom line and eats away from their cash flow model. So I think in my mind that's what it is, just a miscalculation, and the end result is taking on bad debt versus good debt. But whenever you take on debt and you structure it the right way, price it the right way, and utilize it the right way, it winds up being good debt because it translates to better revenues and a better bottom line for your company. I saw a segment of the business market that I felt was underserved, and that came very clear to me during the period of time where PPP loans were being given out. I felt that the big, large banks were taking care of their own large clients first, working their way down to their own clients on a smaller scale. So there was a lot of businesses left with no help and no guidance. And to me, whenever that happens, that spells out to me an underserved market where you have people seeking the help, seeking that service, and no provider really catering to that. So I felt that's a good a segment for me to focus on and supply that help and guidance they needed. Well, a traditional bank, and to use, let's start with the big names, the big national names like the Americas of the world, the Chases, the Wells Fargos. They create a credit box, right? And basically their guidelines, and you as the client or non-client either fit their box or not. So not all boxes are created equally, credit boxes. So if a client is coming from Chase or Bank of America or Wells and they then don't fit their credit box, their guidelines, it doesn't mean they're a bad client. It doesn't mean they're a profile. They just simply don't fit that model. So my goal is to really evaluate the client's needs, their financial profile, and just find a model that's more suitable for them, for that need. Oh, 100%. I mean, you have to be a good storyteller. In the commercial world, we do what's called a credit memo. And it's basically a narrative that I type up with some key bullet points about the company, their objectives, their projections, just to give the underwriter who may be in a separate location, that may be in a separate market, a visualization of what's happening here. What is this transaction all about? How is it going to help this company? How is it going to help the lender? What's in it for every side? Is it going to be a win-win all the way around? What are risks to be aware of? So the storytelling, the better storyteller you are, I think the better you could put together a stronger case and actually have it get approved. So it's very crucial, the storytelling aspect. So lenders in general tend to label certain industries high risk for a number of reasons. Maybe due to the nature of their operation, there's a lot of risks and litigation involved. Maybe historically speaking, that industry has known to have a lot of defaults, or from a PR perspective, maybe the news media and so on and so forth not well fond of it. So risk management, I think, is top of mind with the lenders, but it comes in different variations. And at the end of the day, the lender, anytime they see a client that's a risk, there's always that thought process of a risk can translate into default, and we're trying to minimize our defaults as much as possible. So it's all relative in the end. Right. So most business owners should understand how to calculate EBITDA correctly. And by looking at their corporate returns, the most common format comes across my desk is typically an 1120 or 1120S. So we're talking S Corp, C Corp. There are, you have your top line number, which is your gross, followed by all the write-offs and different categories. And then you have your net income. But to that net income, some of those categories are added back to further expand that net income, which ultimately formulates the EBITDA. So the EBITDA is what lenders use to calculate the affordability and the ability, the capacity to pay back a loan. So your top line number sometimes is what the lender uses to calculate the maximum loan size you're eligible for, but the bottom line slash combination of the add backs, which result in EBITDA, is used to calculate how big of a loan you can actually afford. Two different thought process. But business owners 100% usually focus 100% on the top line. They ignore the bottom line, and sometimes their bottom line is in brackets, meaning the company has losses, and they wonder why I did phenomenal sales this year, but I still can't qualify for a loan. Well, you have a lot of write-offs and no profits. They can't lend. Lenders don't like lending to unprofitable companies. Not staying disciplined and staying true to the original use of funds agenda. Before they're pursuing $500,000, $1 million, call it, for working capital, what have you, they created an agenda breaking down the use of funds, meaning for every dollar that they're going to borrow, it's going to be allocated to certain parts of the agenda. And by doing that, the end result will be as follows, right? A lot of companies lack the discipline to follow that agenda, in my opinion. And then they get themselves in trouble, or they sometimes exhaust the working capital facility that was just given to them, and 6 months later looking for more working capital. That's a dead giveaway. They didn't utilize the first allocation correctly, and now they're seeking another infusion of X amount of dollars. Yeah, so it's a question that actually raises a point of the characteristics I see a lot in the marketplace. I see a small business owner that takes years to experience any level of growth, and it's usually the mindset of that person and their attitude towards debt, right? Then I see a business owner who literally started year one, and year two they're doubling their revenues. So I correlate it to the mindset of the individual and their ability to, their risk tolerance, because there is a risk and reward relation. And people who tend to take risks understand that certain risks come with certain rewards. But again, you take the risk, it's up to you. If you face should you have a reversed outcome, you're going to be dealing with it. And some clients don't simply want to take any risk at all, and that's fine. It just relates back to their personality and their mindset. But there's a lot of ambitious, aggressive business owners, and they're simply just willing to risk it all to reach that maximum height of success, and the result shows.
Now, if you sat down with a small business that wants to get capital, what would be your recommendation for them to identify if they should or not get loan?
Right. So, you evaluate where they are today. You evaluate their mission statement. You evaluate their objectives, and you just kind of see if there's an alignment and between their objectives, their agenda, and the expectations. Right. You're there to kind of give them being an industry expert. You're there to give them a dose of reality, and you're there to give them real-time feedback on, hey, you're like right on track. Your expectations are attainable. And sometimes you may have to modify and maybe adjust your expectations. But you're there to give them a pulse of what's happening in the marketplace and realistically what companies of their size can't do realistically or unrealistically. Yeah, I mean, if I find my job, my priority is to always add value and put you in a better situation than I find you. So if I cannot do that, I will simply not engage in the transaction or not have you go through with it. So if I see that the solution brought forth will not help you achieve that or yield positive, impactful results, it's just simply not worth it, because I don't need the bad karma, and I don't need the bad publicity for my, I'm trying to maintain a good reputation, a solid reputation. So by doing good for people and adding value and putting them in a better position, I feel that I've accomplished something. If I can't accomplish that, it's just not worth it. There's not really a transaction to be made there. Yeah, so one of my favorite success stories from 2025 is I helped a family that owned they were operating a very successful mechanic shop, but their rent was consistently going higher and higher every 2 years to the point that it didn't make sense to even rent anymore. Luckily, he identified a facility that was almost double in size. The mortgage payment was going to be comparable to what he was paying for rent, but I think the only thing held back was the down payment to purchase that facility was going to be a setback on his cash flow. So we were able to formulate and find a solution where we got him 100% financing. We used projections, we used some other things to qualify, but by not having him to put any down payment was good for his after closing liquidity as well as his cash flow period. And now, going from a 4-bay shop to a 10-bay shop, he's able to scale up his work, hire more mechanics, and obviously he's getting some work from local car dealerships that can't even handle the work. So by getting into that large facility, it's an impactful result to his business. So we're very proud of that transaction because not a single bank in South Florida would have touched it or came close to accomplishing what we put together for this guy. So to me, in my mind, coming up as a kid, my father's friends used to tell me, if you are in the business of money, medicine, or food, you're in a recession-proof business because no matter whether the economy is up or down, people need to eat, people spend money, and people need medicine because people get sick no matter what. So I'm in the money business, obviously. So irregardless of the economy, I'm still gonna have transactions to do, but not every business out there is recession-proof, meaning certain economic cycles make certain businesses suffer more than good economic cycles. Some businesses do better in bad economic cycles. So it's strategically structuring the business and getting them prepared so no matter what economic cycle we face going forward, they're able to survive and thrive, not just barely make it or be on the verge of closing their doors. So a lot of it is education, planning, and proper execution. And that way, if every client faces a bad season or a good season at different parts of the year, they know it's coming and they know how to better prepare for it from a financial standpoint.